Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. It's Tuesday, right? It's Tuesday. Maybe it's already a long week. Hey, it's the 13th, though. We got CPI today. We have bank earnings we can talk about. So today is going to be a focused day. We had too much fun yesterday making fun of Ace. Today, a focused day, all right? So to the charts. Here we got the E-mini. E-mini did pretty well yesterday. In fact, I was actually a little bit shocked about how it traded yesterday. It just seemed like way excessively bullish. We're coming into earnings season now. Remember that banks are usually the first set of earnings, and we got those from JP Morgan and Goldman Sachs this morning. So, which was a little bit mixed, by the way. And as such, we may have a really interesting market open in the S&P 500. Moving over to treasuries, there was a pretty good move up early on, but the auctions were not very good, and the yields did increase as the S&P 500 was just gangbusters up. So at least there's some sanity in this market. Oil still looks fairly well supported. It looks like there won't be any OPEC developments until next month, so we'll have that hanging over our heads this whole time, which sucks. Gold and silver, still range bound, but towards the top of the range, so that's good. Copper still meandering. So yeah, but the thing that matters, CPI coming out here in 2 minutes, and we are looking for U.S. CPI month over month to be spot 5. Now, be advised. It may come out pretty close. I would be surprised if we're anything different than spot 4 to spot 6. However, there's probably going to be a lot of nuance to read into the how do we say? There's probably going to be a lot of nuance that we can read into the report itself, so we're going to need to pull that up and read it. All right, let me make sure text-to-speech is turned on here. Let's see here. Data is not on. I will not turn the robots on until after news, though. All right, here we go.
Block zone.
Ouch. 0 spot 9. Holy shnikes. Oh, wow. That is so strong that I can't really actively trade it there. We could move a little bit lower, but that one's a tough call. You can see the lack of latent liquidity there at 07. Good God, that is insane. Okay, let's refresh over here. Is it going to show me a July? The consumer price index for all urban consumers increased spot 9%. in June on a seasonally adjusted basis after rising spot 6% in May. The U.S. Bureau of Labor Statistics reported today. This was the largest one-month change since June 2008 when the index rose 1%. Over the last 12 months, all items index increased 5.4% before seasonal adjustment. This was the largest 12-month increase since a 5.4% increase for the period ending August 2008. The index used for cars and trucks continued to rise sharply, increasing 10.5% in June. Okay, so hold up. That is important. Okay, so transportation services. Or no, let's go back here. All items spot 9. Food was spot 8 versus spot 4. That is problematic. Energy was 1 spot 5 versus 0. All items less food and energy was 1 spot 7. Commodities less food and energy spot 9 versus spot 7 the month before. New vehicles 2 versus 1 spot 6 before. Used cars and trucks 10 spot 5 versus previous reading of 7 spot 3. This is just bad all around. Wow. How do I put this in the title? Well, okay, so first of all, up in here, I could probably justify something. So Uzi says it's transitory. Blowout CPI numbers cause market panic. That is what's going on. Oh, it's the 13th today, by the way. Save. Am I getting that? Oh my. Wait. Probably it's going to be a little bit more difficult than that. Holy balls, my favorite 2 words this morning, man. That was pretty crazy. Yeah, I thought so. I think that I can probably get my target, but it's going to take a really long time and it's going to be really difficult. If you think that was pretty crazy, please smash the like button. If you feels that was a holy balls, please thumbs up. Yeah, hit the like button, guys. I think that today, if there's a day where it would be useful for people to see this stream, I think today is one of them, yeah? So smash the like button. Man. This is gonna be crazy. And here's the thing. Well, so let's go back. While that is going, we also need to look and see if we got more information about the earnings. Bum 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 ba-dum. This will read Zero Hedge's synopsis, if that's okay. Big Bank number 2 results are out, with Goldman reporting Q2 earnings, and just like JP Morgan an hour ago, the vampire squid reported solid, if not blowout, bottom line earnings, however, offset by a modest FICC trading revenue miss. Well, That's kind of been the story in bonds, hasn't it? Net revenue, 15.39 billion, up 16% year over year. And once again, not only smashing the median estimate of 12.43 billion, but coming above the highest estimate of 13.54 billion. Earnings per share of $15.02, up quite a few orders of magnitude from the 53 cents reported a year ago. Once again, beating both the median estimate of 10.15 and the highest forecast of 12.02. Hey guys, do I feel good about keeping my Goldman stock? I do. I feel very, very good about it. Like JP Morgan, Goldman also reported blowout investment banking revenue of $3.45 billion, up 26% year over year, an estimate of $2.92 billion, and strong equity sales and trading revenue, $2.58 down 12% year over year, but beating the estimate of 2.53. However, this was offset by a 45% drop in fixed sales and trading, which slid to 2.32 billion below the 2.49 billion estimate, and led to a miss in overall trading revenue, which came in at 4.9 billion, down 32% year over year. Okay, which is actually okay, because Goldman is trying to move towards less of their performance being tied to their trading revenues. So, well, I'll tell you what, right there, I want to be hyper accurate with my trades here today. And, well, not hyper accurate, but like here in the treasury, there's going to be plenty of opportunities. Let's just sit out for a little bit. I'm kind of wondering how far back this will snap, because clearly the liquidity is like not there. Here's thousands trading. I don't know. This could flip back quite a bit. It becomes really hard to trade. Solomon has a reason to be happy. As Bloomberg notes, there are a lot of second highest superlatives with these results. The bank reported the second highest quarterly net revenues, the second highest quarterly net earnings, and the second highest quarterly diluted EPS ever. Also, like JP Morgan, Goldman made progress on trimming its costs last quarter, with operating expenses down 17% year to year. Yeah, that's at the expense of my friends. That's okay. Goldman attributed the decrease to lower non-compensation expenses, particularly lower provisions for litigation and regulatory proceedings. Well, okay, that would help too. However, like JP Morgan, Goldman took just a $92 million release, far lower than JP Morgan's $3 billion. Those reserve reductions were on the wholesale and consumer loan side. There are some provisions related to portfolio growth, but that was primarily in credit loans. Ba-dum. So how are Goldman shares trading after this impressive second best ever quarter, in which if it could have done better? It appears that the market was expecting just that, with GS shares largely unchanged pre-market. JP Morgan was down like almost 2%, right? So that matters. Hey, Hey Keller. Okay, so now let's come back and see we got anything. Okay, News Squawk says CPI snap analysis headline and core prices rise above expectations in June, but real weekly earnings decline and used car prices contribute much to the upside. This may allow the Fed to continue arguing that inflation upside in the near term is transitory. I'm not so sure about that one. So the big thing that sticks out to me in this report, I will put this up and I will leave it here so you guys can see. All right. The big thing that stands out to me in this report is that food inflation was spot 8 month over month versus spot 4 a month before. That seems pretty significant. Energy I expected, but hey, energy is getting more expensive. Okay. Commodities, less food and energy, spot 9%. That's very, very high. Well, where is that all coming from? Commodity, less food and energy commodities. That's a 2.2. Apparel did decline from 1.2 to 2.7. That's still really hot though. Medical care commodities actually decreased. That's interesting. Shelter is the same, right? Oh, sorry, that was services. Services is the same. Shelter, spot 3 spot versus spot 5. Here's the thing. I don't think that we're even close to seeing the real change in shelter. Ooh. That seems not so good, right? And here's unadjusted 12-month numbers, right? So there you have it. There's the numbers. Let's see if I can get it. Yeah, that's perfect. There you go. Now you can see them all. Okay. That is more than just, used vehicles is pushing the number up, right? Now, can the Federal Reserve argue that it's still transitory? I think that they can, but I don't think that there's anything in the report that says that it's transitory. Explain this to me. Why is it that food inflation is transitory, right? I don't know. Those kinds of numbers, I think, lead to more inflation. I think that those increase people's inflation expectations. And that is a problem. Reflexivity, right? Okay, coming back over here. Forex Live. How is this even possible? Used car and trucks. Unadjusted 12 months. 45 spot 2. Yeah. That really right there. How is that? What? So is this inflation snowballs? I don't know, but this, so now I need to come back to the volume profile and look at the mini here. Okay, so we're still into yesterday's prices. 34, 43, 37 is a significant pivot from yesterday. So when you look at this, the S&P 500 is handling this actually really well. Did we get all the way back up to 14? That came back very quickly. It's just so funny how when they started the COVID stuff last year, that the impact on the economy was so predictable, while all the normies were like, nah, it'll be fine. I'm very curious to see what the used car and used truck prices are separately. Oh my gosh. Okay, so my uncle, he has two nice trucks. Well, they're Japanese trucks. I forget which. I think they're Nissans. I think they're both Nissans. And so he bought a new one, like a nice new one. He's in his 40s, but he's single. He's never been married, doesn't have any kids, anything like that. So he just does what he wants. So he bought this new car, but then he was like, I don't want to sell my old truck. And I'm like, you gotta sell it. Like, it's probably worth more now than when you bought it almost. Big payday, but he doesn't want to get rid of it. He wants one that he can trash, I guess. One that he can carry stuff around in. So, okay. The inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. No micro CL trading yet. I need someone to guinea pig bracket orders on both sides of the oil inventory report. Will probably be me. Well, I honestly haven't pulled it up. No. In my mind, I'm thinking treasuries. Probably we could try and get something off of the close bit that happens in oil at like 9:30 or whenever it is. I've been shared some trades on that do seem to be pretty decent. Patrick Rooney is stating bonds don't care on the CPI. Yeah, I don't think that's the case. It's already out, isn't it? I mean, I haven't tried looking it up, but everything that I see on Twitter is kind of suggests that it's already out. Okay, but so when I'm looking at this, I'm gonna see like liquidity disappear, a strong move, and then if there's no latent liquidity, maybe even a pullback. But it went up. I don't know. It kind of looked like maybe it was gonna settle, and then it came down, and now it's moving back up. And I'm kind of wondering if what I'm seeing here is actually a larger play, like somebody trying to say, well, yeah, that is a really blowout number above expectations, but it's still not going to change the Federal Reserve's opinion, and therefore doesn't matter. Because it does seem like there's still some sort of desire to buy it. Interestingly enough, though, okay, well, that's all you had to do. That's all you had to do. I was gonna say it seems like there is an underlying bid there, but the actual cumulative delta has not reversed at all. We're down a good 40K. Yeah, the 40K or more, 40 to 80K now, really, of selling. So, wowie. Thank goodness I still have 10,000 barrels in my yard from that mistake last year. Oh my gosh. Every time I look at that, what I keep thinking is our so-called expert in oil. Gary was like, no, we may never get back to those high oil prices again. When it was like oil was going negative, and we were like, well, we should wait for the dust to settle a little bit, but maybe now is a time to think about what we want to buy when it calms down, and because it will come back. And it was like, and so many people were like, nah, I don't know if it's a really good buy. It was like the one thing that you should be good at, and you got it dead wrong. Kind of bothers me. Everyone was talking about taking delivery. Yeah, well, a lot of people got screwed over on that trade, to be honest. I saw some complaints. I'm not going to say it was confirmed stuff because, okay, so liquidity is actually kind of starting to hold a little bit down here. I wouldn't call them like confirmed because it's still like hearsay on the internet, but I saw some reports from people where they were getting executed during that stuff when they should not have been. It was really quite, yeah. Oil going negative was like the perfect example of where, a trader can get screwed over because all these guys who were buying it, they had the right trade in the long run, but it went and screwed them all over first. Oh man. And so many people at that time that were interested in trading it. I'm like, you guys are insane. Like, oil just went negative, and oil is something that can move $1,000 a day on one contract. And that's when you want to get involved in that market? Come on. You got to be crazy. Crude oil comes in super convenient barrels, so anyone could no. It's actually quite so. I think that it would be very difficult to get them to deliver it to your house. You would have to arrange for it to be delivered there and everything. Normally what's going to happen is it's just being held in a warehouse somewhere, and you have to pay them to hold it, which is very expensive, by the way. Okay, well, the treasuries are coming back down to the lows after that big old order got crushed, and now the S&P 500 is falling as well. And like I said, you don't really even get into like prices at which technical traders would even really read it as significant until 43.57 or so. So if there were to break some new lows, I don't know. Could this create a trend down day? I think it certainly could. Wow, if I'm gambling, I like Palladium futures better. It was moving $5,000 a day, really? The back months, yeah. So we should remember that day that oil went negative, that it was only the front month that did that. It was certainly a weird move. I'm not going to pretend that I understood everything that was going on then. That was I think that I kind of knew theoretically that a future like oil could go negative. Like as soon as they said, "Oh, well, it's negative," that means that you're paying them. That all made sense to me, but I had never heard of it happening before. And again, like that was when I knew. Like honestly, the whole GameStop thing didn't surprise me, because at the start of the pandemic, the oil market fell apart, and I had dozens of people on Facebook, people that I know from going to raves and stuff, that were asking me about how to trade oil futures, right? Like it was very clear to me that back then that there is this huge group of millennials now that have suddenly discovered the market. They finally had the time to sit down and are like, oh yeah, these financial markets, these are something that are important to me now that I'm 35 years old. and of course I told them, like, dude, you don't want to mess with futures, especially not oil futures in its most turbulent time ever, And so it doesn't surprise me that a lot of them turned around and found like the short squeezes. The shoe sign so boys started giving. Did you see my my TikTok about that? Oh, let me see if I can find that. Yeah. I don't think I showed you guys that. Oh, it was way back. All right, here we go. Hold on a second.
This is Stock Market Steve here on Wall Street to give you another day trading tip.
Oh, you're a stock guru?
Oh, hey, just ignore this kid. It's the shoe shine boy, he's doing my shoes.
You should check out ASO.
ASO? Hey, you know what, kid? Actually, maybe that's not a bad idea. Hey, guys, I gotta go. I got to use my phone to go buy this stock.
10
but
seconds.
Remember, don't be poor. This is Stock Market.
Okay, here's the best thing about that TikTok. Let me turn this up so you don't hear the squawk. Here's the thing that was so funny about that TikTok. That day. Let's see, go back 6 months. Oh, it's not doing so bad now. Academy Sports. But that was back in June or oh wait, we gotta go way back. We gotta go back 1 year. That was like right here, I think. Like the price declined like 10% after that. It completely crashed the next day. It was so funny. I was like, I could not have picked, because I had a lot of debate in my mind about which stock should I pick. Well, ASO is the new hot one. that seemed suspect to me. And yeah, the next day it just completely cratered. It's closer to a deaf Canadian. I know. I don't think that my accent delivery was too good. I was kind of trying to split the difference between a Brooklyn accent and like the more Jewish accent, and I don't think that it was really all that great. Double bearding sounds illegal in Utah. Let's see here, Stickball. Basically, you know how CME has position limits that become more restrictive as time approaches delivery? This is so the delivery hub does not reach its capacity, but what? Oh, right. But yeah, the whole thing was crazy, man. Okay, well, those new lows in treasuries were pretty convincing, weren't they? I don't know. So here's the thing with trading oil, though. In my opinion, the way that a retail trader in futures can gain an advantage is in understanding their instrument better than other people. So, and I think that people always interpreted that as, well, you know what kind of patterns it tends to do and things like that. I don't even think it's that. I think it's like understanding the structure of your market. So if you want to trade treasuries, for instance, a really big thing to understand in research is that forwards. So like treasury forwards, that is like what price would they be giving me if I was to take delivery a month from now or whatever? But today, I forget all of the complex math about how you calculate forwards. But what the market prices and sells the forwards for tends to overstate how much interest rates can change in that time period. It's the opposite. It's really the opposite of the VIX, which has very significant consequences for the treasuries, right? Like, you know how we've always kind of had this discussion about the treasuries kind of have this really confusing dual nature because they can trend, and when they get moving, like they really, really move, but they'll have these really clean pullbacks. And overall, they tend to be very mean reverty. Well, why do they overall tend to be very mean reverty? Mean reverty is that even like, that sounds like such a stupid word, but because the market knows that the forwards tend to overprice how much is going to go. So all of the market making activity that goes on in the treasury is based on fading those moves, right? But then when there is a repricing that needs to happen, even though like the treasuries are the most liquid instrument in the world, there is not even close to enough liquidity for them to price these things out. Like right now, while the S&P 500 has just cratered to 43.57 quite quickly there, wouldn't you say? Winston has a link to CFA level 2 economics calculating forward rate and forward premium discount. There you go. Yeah. Anyways, that is something that you should understand about the treasury market. That is something that like I was kind of like, how did I go for years without knowing that? Right. But those are all important things to know about your market, about how it functions. And this whole thing about how the treasury market's about how the cheapest to deliver works, like those are the sorts of things that you need to know and that you as an individual retail trader can gain an advantage on. Okay, because if you were trading at a firm and you were trading a market making strategy, or you were programming a market making strategy, those are the things that you would be relying upon as a basis for your strategy. So it would behoove you to know them, right? Well, the issue that I have in oil is that I've spent all of my time on other instruments for starters. So I guess partly it's a sunken cost fallacy, but understanding the oil market is just not my forte. Well, and particularly the politics behind oil. I find the politics behind oil quite inexplicable. And I find that I am very much behind the curve usually on those. And so I would require a lot of work on my part, I think, a lot of learning for me to get to a point where I could adequately trade oil. And all for a market that is, I mean, I don't know. I'm not particularly fond of the kind of price movement that we get in oil. But the one thing that I do like about oil is that it is like the one future that I can really think of that it's large and it is a primary market, you know? Like when we talk about treasuries, there's a lot of order flow, and you can get a pretty good read from the 10-year treasury from reading the order flow, but it is a secondary market. There's still a cash market and a lot of stuff going on in the cash market that I can't see, especially when it comes down into order flow and individual issues, right? You don't get that in the oil market. You've got the CL and you've got the Sweet Light and the Brent, and that's it, you know? And those are the primary places that oil trades. So that's the thing that I think is attractive about oil. But I don't know if I can realistically get it's not just like the sunken cost fallacy of that I don't know oil. I don't feel confident about my ability to really become an expert in that instrument. Yeah. If uninformed traders are herded into being one direction, then you can tap into the edge. Well, so the way that I would put it is like with the forwards. So what will tend to happen is you will get a big move, right? And then the forwards will like really overprice it, right? And that's where you can try and take a mean reversion trade, right? And in bonds, if you were going to trade that mean reversion trade in bonds, it would probably involve buying the actual bond. And I don't know if they offer margin for that sort of a thing. It might be something worth looking into. But, you know, you like sell, you buy the bond on the expectation of it coming back. So you don't want to do it when the herd is all going one way. You want to do it like after that. Like when the herd is going all one way, that's when you lose money. But it does create the opportunity. I was just trying to clarify. For example, because we order a big meal and have paid for it, we feel a pressure to eat all the food. No, I think that is something that we got taught from our millennial or our Great Depression, post-Great Depression grandparents. Good morning, Ace. So, Ace, how about buying the no. So one thing is I'm looking at this and I'm like, should I have taken the trade in the E-mini versus the Treasury? Well, there's a pretty good trade in the E-mini. It's really the same trade. I feel like when you're trading CPI that Treasury is a more pure play on it. But also, you know, you get this thickness. So I kind of like that about it. So I think in this situation, I do like the thickness. Now, the advantage to the E-mini may be that we still got like 30 minutes to the open and then the open. So there's a potential for quite a bit more downside here in the E-mini. I'm kind of this is the moment that I find the most interesting, because surely there is a way to look at what the CPI is and calculate the effect that would have on the S&P 500 and to estimate now that we got spot 8 versus spot 5, where the S&P 500 should move down to. Surely there's a model, right? But I don't have that model. So when we've moved down to 43.57 and bounced, what would that model say? Would that model say it's done? Or would that model say there's more left in it? And what I'm trying to do here, what we're trying to do is we're trying to determine if there's more in the move or not without the model, you know? And depending on how far that is in the S&P 500, it makes the S&P 500 a lot more interesting. Yeah? So I don't know if it's going to continue, but I'm willing to make a bet that it will. I think that the potential rewards are pretty good here. Forex Live tweets, here are the items really driving up inflation. Used cars 45%, gas 45%, laundry machines 29%. What? Airfare 24%. That's the airfare is probably largely just due to like year-over-year effects, right? Moving 17%, hotels 16%, furniture 8%, bacon 8%, TV 7%, fruit 7%, shoes 6.5%, fresh fish 8%, new cars 5%, milk 5%, rent OER 2.3. Tom Sosnoff from Tasty Trade said on Monday that he's short 5-year bonds and long the 10-year. Is the bonds themselves? He has a flattener on. When is JB? I don't know. They have a press conference set up. Let's go. Have you ever seen this calendar? Let me tell you what. This is like the best calendar I've found. Finance earnings report calendar. I'll put the link here in chat. And this is really good because it tells you like when the press release is and when the conference call is. Okay, so it says that the conference call is an hour after the market opens. That's interesting. Stick asks, why would you want to long the bonds instead of just owning them? So, from what I have seen, so this one is kind of interesting actually, because here's the thing. CPI was high. So the knee-jerk reaction that we should expect to see in the treasuries is down, right? We should see down because what? We're getting inflation, which increases the chances of the Federal Reserve needing to raise interest rates. Okay? So outrights will tend to go down, right? But there's another part to this, which is, do we expect interest rates to be rising over the mid to long term? Well, off of that news, I would say that the chances of that happening are higher. So we should expect on a relative basis the 5 years to move more than the 10 years. Okay? We should expect the curve to steepen. All right. We should, or at least I would expect the curve to steepen. It's been flattening a lot, right? I would expect it to steepen. Well, 2s and 10s did steepen. but 5s and 10s did not, and 5s and 30s did not. So, and I really should, maybe I should just have one. I need to figure out how I do this. I don't want to add more stuff on here, but I really need to see the difference between the 30 and the 5. That seems to be the one that has the most, yeah. How do we do this? No, I'm just going to add it. There's no way around it. So, I am getting myself a little bit out of the okay, it's 4-1. I'm letting myself get a little bit distracted, but this is worth looking at. Okay, so there's spread, and I will also do spread. This one shall be ZF4 ZB to 1. Okay. Interesting. So they all kind of flattened it except for between the 2 and 10. So what did this guy do in, let's go back here. Tom Sosnoff said that he's short 5s and long the 10. Oh, okay. So then he probably made money off of that move. He probably made money off of that move, depending on how he did it. Right? Okay, so anyways, basically the thing here is that, like, the yield curve is much more of a hedged play, I guess you could say, right? Like, the treasuries outrights could filter all over the place, right? But the curve, we should expect to see it steepen. What would you use to chart yield curves? Spot prices or futures? Hard to get spot prices because it's all interdealer market OTC, correct? He said he was heavy on the hedge side, long tenure. But is he doing it with the bond or is he doing it with the future? So there's a couple of things. One thing is that, yes, if you do it with a spread, you can kind of like leverage it a lot because the amount that spreads move is not very much. They also tend to be relatively consistent. But the issue, it says, I know you pay me good money to argue with you, but I just can't argue about the bond curve. That's okay. These are important things to understand, though. Someday you will find it useful, I promise. So there's something on with treasuries. This is what makes the yield futures that are going to be coming out so interesting. Okay, so you got to remember that the 10-year treasury future provides delivery. Okay, which means that if I hold it into the delivery month, I have the chance of at any one given time being called up for delivery if I'm short. If I'm to sell somebody $1 million worth of treasuries. Okay. And the way that they do this is they have a reference rate and that everything is priced against, and they have eligible securities. Okay. So they have a list of the treasuries that meet the standards of what the delivery should be. Okay. So there's multiple bonds that you could get, right? Coupon. But the issue with that is that those are all not going to be they're not all the exact same, note, right? This one could be a month older than this one, right? Like this one, the auction where it was delivered to the market was a month's different, right? And so if you were trading the actual QSIPs, the actual treasuries themselves, the prices of those are different, right? Which means that there's one treasury that ends up being more efficient for you to deliver if you're actually going to deliver, okay? And so the treasury tends to follow the cheapest to delivery of those treasuries that are, eligible, okay? So they trade like that for that reason, because they want to have a way for there to be delivery. All right. Now, as a result of that, we are also trading off of prices here in the treasury. Okay. Now, there's an issue with that when it comes to doing spread trades. And that is that the DVO1 changes. So the DVO1 is the price value of a basis point. That's what it means. Okay. O1 is like, I'm trying to be super basic because I know that some of you guys don't know. Oh, if you have it, if you have an interest rate and it changes 0.01%, okay, that is called a basis point. That's why it's called DVO1, the dollar value of O1. Okay, so the dollar value, how much this moves when the interest rate moves, is not fixed. Okay. And it's not fixed between any 3, 4, there's a bunch of them, but really there's 4 that we care about. One, I don't show the 2-year, right? But that DVO1 can change on these things. So if the DVO1 increases, then that means that a change in interest rates will actually move the treasuries more. Right? And if you go to the CME website and you look at the Treasury Analytics, it will show you all of this information. Okay. So if you are taking a spread trade and you are short the 5-year and long the 10-year, but then the DVO1 changes, right? So these all go down, but the DVO1 changes and gets less than over here, then it could be a situation where like it kind of moves, but you don't actually make money because the DV's changed, right? So Stick says tick value changes. You're saying, well, it's not that the tick value changes. I mean, a tick is always worth 15.125 or whatever it is, right? But the tick value, how much this moves when there's a 1 basis point change does change. And that matters because this is the thing that actually changes, right? Like if the Federal Reserve came out and said, we're emergency raising interest rates by 1 basis point, we should be able to come in and calculate what all of those underlying bonds are actually worth based off of that DVO1 change, that 1 basis point change. Okay. So really, if we're making a spread, if we're trading the yield curve itself, the DVO1 is an inefficiency in the market that we have to account for, essentially. But if we're trading yield curve futures, we don't have to worry about that. Then we're really truly trading the yield itself, and we don't have to worry about the DVO1. We don't have to worry about the cheapest to deliver. Then at that point we're trading the on the run. So there will be a difference between the yield curve future yields and the calculated yield on the 10-year Treasury future. There will be a slight difference. They also show you that in the Treasury Analytics. They show you the difference between the cheapest to deliver and the on the run. And then the difference between that is, I believe, what they call the repo rate. With me so far? Right? So I'm a little bit unsure if you had taken a short on the yield curve flattening, what you would have actually gotten out of it. But it's interesting to think about what it's going to be like when you're able to trade the actual yields. Right. And then when you're trading the actual yields, you should be able to like really leverage up and just make a really pure play. So what I was kind of getting at is that really you want to think about what is the thing that I think is going to happen. DVO1 changes the amount futures move. It's kind of the opposite, right? The amount that the futures move changes the DVO1, and hence how much the interest rate changes in response to these price moves. How do you calculate DVO1? Oh man. So if you go to the CME, and in their education, they have a treasury, they have a series, they have a 4-part, there's 2 series, and they're both 2 parts about treasuries. But I have to pull my notes out. Let's see, do I have in here the ding, 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 ding. Yeah, see, that one gets a little bit more complicated because you have to start worrying about conversion factors and stuff. And I don't think that I have that completely written down in my notes. I don't think that I could, on the fly here, recall up those formulas and see. Well, man, I got a really good excursion on that trade, and it's come almost all the way back. Yeah. And in that course, they talk about that stuff. About how they calculate the DVO1 from the conversion, because it's like, it depends on the conversion factor and the rate that we have at the moment. You think the E-mini is going to buy the dip? That would be funny. Stick says, yeah, true, but I thought Tom had lots of money to just own bonds, but short near-month futures. Who knows? The thing is, you could do a trade like that owning the bonds. I mean, if you're like a bond fund, that's probably a large part of what you do, right? And then you use the futures to hedge yourself, right? But I think if we're doing interest rate futures, at that point, I think the incentive to do spreads starts to become really high, because you imagine you something that you only make or lose $1 as it ticks up or down, right? But then you're doing a spread on it, so you only make $1 when the spread changes, right? And it really comes back to, oh man, so there's block buy. Somebody really wants to own these, huh? So it was like I was saying before. I mean, before I took this trade, really, right? There does seem to be somebody that wants to buy this. Well, look at that. He rose his bid up as they went, and they took him out, and now it continues up. Ew. You haven't seen rain in months? It rained like on Saturday. What are you talking about? You try to short it 13? Oh yeah. Sucks. I would like to keep this. I don't know how much risk I'm willing to hold on it, but I think I still. Oh, you were out of town. Oh, okay. Uh-huh. It was like 2 years ago though when I did the course. No, there's like a more recent course that was like advanced treasuries stuff. That was really good. Although I'll admit a lot of the stuff that I've learned more recently came from a book that I read when I was on vacation. Man, I have a lot of study to do on that. I don't know when I'm going to end up doing it, but like I really feel like that these formulas that we use to calculate how much a bond is worth should be like memorized. I mean, they're memorizable. They're not that complicated. It's something like $100,000 plus e to the rate times the time that you're going to hold it, right? We had this 2-month dry spell and then suddenly endless rain. Really, even in Florida? Are you getting yellow spots in your yard yet, Ace? Because I have like 3 or 4 spots in my yard that are just straight yellow. And it doesn't matter like what I try to do to it. It just stays yellow. It probably needs to be aerated. This kind of sucks. Like we put all that effort to getting the yard, and then ever since we've gotten it, it's just been really tough to really get it looking nice. Better way to look at it is we have a few green spots. Oh, well, I'm not talking about, well, the grass is not vibrant green. It's all kind of a light green / yellow. No, I'm talking about patches that are like straight yellow, and if you don't do something, are probably going to die and turn into brown, turn into dirt. Seth, you told me many times, but why exactly did you stop working at the bank, and why didn't you go to join a different bank? What was it about investments? Well, so there's a couple components to this. I think if I'm honest, the biggest factor was that I got hired by somebody else almost immediately afterwards. Like they said, okay, we'll have you go through a training course to brush up your resume and help you work on your networking and all of these other things by Lee Hecht Harrison, which was all amazing. I got to tell you, they have all these things where like people say, you spend money and you'll get your money, but like it's an investment in what you learn and develop from that. You should make it back. But then like that's never what happens, especially when people are selling you trading systems. But I have to say, man, that Lee Hecht Harrison Goldman paid a lot of money to send their employees that had been let go to that, and it was worth every penny. Oh man. So I waited, like I think it was a month. I think I waited a month to when they had me scheduled to do that, and I did that thing. And then after that, I put everything out there, and I got called by a recruiter, and a company that I work at now very aggressively pursued me. I mean, it was like literally the next day was like I completed the course. The next Tuesday, I went and interviewed, and they gave me an offer on Wednesday. And the offer, I was looking for a lot, and they gave me more than I was asking for. It was like very aggressive, I thought. So that's probably the biggest factor. Okay. The next factor is that in reality, I really always wanted to be involved in trading. I guess I think about it different because I guess my conception of what a trader is a lot different now. Would I like to trade for a bank? I'm not sure, because trading for a bank is very different from what I do, right? So you liked it there. I really liked working at Goldman. Yeah, it was very stressful though. I don't know if it was worth the stress, to be honest. I mean, most of the time it wasn't, but there was some periods there at the end that were really stressful. And I think back on it, I'm like, well, you know what? I never had to deal with that kind of stuff where I work now. So why would I do that? You know? Because I've been looking online, and I mean, I'm always keeping an eye out to see if like there's a local fund of some sort that I can get my foot into. And I did see that Goldman were hiring people to do like the actual treasury analytics, that to be writing the pricing models for corporate bonds. And I was like, well, that would be something I'd be interested in. I don't know if I know enough about it to really get the job, but then I thought about it and I was like, yeah, but I wouldn't be able to stream anymore. I wouldn't be able to trade futures anymore. Like, there'd be a lot of restrictions, and would it be worth it? Would I? Not unless they were really paying me a lot. And Goldman tends to be stingy with how much they pay you, and only you only pay up because of bonuses, right? Like if the bonus is good, then you make a killing, but otherwise it's kind of ho hum. So, right. So those were kind of the factors. So it was kind of like, if I were to go to a bank, if I were to go back to a bank, I think that it would have to be me actively trading. And I don't think that I would get a job like that unless I lived in New York. And so I kind of just stopped looking because it didn't look like it was a realistic goal in line with the things that I really cared about. I want to stay where I live right now. I don't want to live in New York. I don't think that I could convince my wife to live in New York. I suppose if somebody offered me a trading job in New York or Chicago, I would try and convince her to move, but I don't know if I'd be able to convince her. Being at a large bank seems like a great place to talk and learn from many people who know about the many different areas of an investment bank trading private equity liquidity. Well, yeah. So the thing that I think hurts the retail trader the most is that there is a lot of esoteric knowledge about the markets that has traditionally been kept private. Like, it really was information that was passed from person to person. And the way that the firm was set up was in such a way that forced you to have to go and talk to people. For sure. Man, this bid here in the treasuries is, I'm awfully suspicious of it. But I don't think it's fake or anything. Well, I don't know. So the order flow still continues to be selling, even though we've moved up quite a bit. So whoever's buying has done so passively. But I don't think that it's just a fluke. I think that somebody is probably really buying in here. Stick says liquidity transformation. I don't know what you're referring to there, but anyways, there's a lot of that knowledge, and it gets past. They were kind of trying to change because they were finding, especially in technology, that just didn't work. Right. So they were trying to get to people to be more, passing that knowledge through things. And there are books, but it's kind of like, the thing is like, what books do you read? Right. Because the books that I've looked at are like really boring stuff. Right. And things that I would never search for as a retail trader. How many retail traders do you think there are out there searching for treasury pricing fundamentals? That it just doesn't happen. The treasury bond basis, you don't search for that stuff, right? But it's funny because it's like it's central to how the markets work. They price things, and the fundamental basis of pricing things is pricing what a bond is worth based on the interest rate, right? Everything that you do in stocks, it's the same thing. It's just that the expected earnings from the asset aren't consistent. You have to predict what the expected earnings from the asset are going to be. But you use the same basic formula from there, and you just gets more complicated. So basically, stocks are just like bonds, more complicated. Well, the open so far has been a buy, but the order flow in the E-mini is really subdued compared to what I thought it would be. Can you say that? Treasuries look like they're going to try and get back to the opening price. 6 says the time value of money, right? Well, it doesn't really. It's really like so like I think that the way that they tend to look at it is like, you know, what the cash value of, you know, that it's $1 million bond or whatever it is, and you know what the interest rate that it was when it was created and what the interest rate is right now, and you can go in and you can say, okay, for each month, right, this is how much it's going to pay out, so this is what it should be worth. Like I was saying, e to the RT is like constant compounding, right? And then but then what you're going to see is that what the market prices is at is going to be slightly different, right? And that is like the risk factor, essentially. So then you can kind of quantify the risk that you're taking on by holding that bond, that the risk that the other person won't pay, essentially, right? And that's really where you make your money is really what it is it's the value of risk. Well, if it comes back to the news price, I might take another short contract. What if companies were just honest with their predicted earnings? Maybe if CEOs weren't paid in stock options? Well, but this is why, like, think about it. This is why Wall Street is so interested in, like, what are future earnings going to be, right? That's why everything is about calculating future earnings. Makes sense, right? Because that defines what it's about. That when you get into like modeling, like that black paper, the so-called black paper from Nassim Taleb makes a lot more sense, right? Because his argument is, okay, like, what is a currency worth? Because there's different models to value what a currency is worth, right? Well, because Bitcoin moves so much, and because the actual adherents of it are kind of trying to say it's not a currency, they want them to be treated like securities. Okay, so what Nassim did is he said, okay, so let's try and value it like a security. And he's pointing out the fundamental issues with valuing it as a security, because there is no future earnings component of a cryptocurrency, right? So it's based off of what people want now, and then there's this absorbing barrier, which is like a more complicated thing. But basically he's saying if there's a problem in the future where people move to a different technology or whatever the reason is, then fundamentally it's not worth anything today. And he's right, if you're going to value it from that perspective. But I think that the counter argument to his paper is that that's not the correct model to value Bitcoin. It should be valued based off of the value of the network itself and how much you're willing to pay for access to the network. So there's some fundamental differences between how Bitcoin works and how a currency works that I don't think is really applicable either. So it's a token, We shouldn't be calling it a currency. We should be calling it a token, because that's what it is. Like think about the fundamental problems with building a whole economy off of a token. Then it makes a little bit more sense, right? It acts like a commodity. So there's been much to do about this so-called stock to flow model, and applying the stock to flow model to Bitcoin and so forth. But I think that there are some fundamental flaws in doing that, and that when you look back at the history of that there have been significant price movements against the stock to flow model that can't be accounted for by that model alone. And so while it is useful, it's not enough of a complete picture to really use. And if I were to write a paper about my own model, and I really wish that I was in contact with somebody that was like in the scholarly world and was interested in doing a paper about it. But maybe it's not worth doing a paper about, I don't know. But if I was going to write a paper about, like, that's the argument that I would be making, is that the stock to flow model has some usefulness, but that we need to get more detailed than that to really be able to make useful price predictions. I'm really interested in the overall market model that you're talking about. Well, so it's not an overall market model, right? We're talking about the modeling the price of individual securities is what we're talking about, right? I have a larger overall market model, but that is something that is so complicated that I don't really think that we have the math or technology to really model yet. But we can certainly break down into components of it. Comes to being a hybrid between bank deposits and physical cash. I don't know. I'm just telling you, think of it like a token, and buying the coin is buying the token, and how much you buy the token is based on how many people are already in it. How much money has already been put into the ecosystem determines how much the token is worth. It's a token where the value of the token is based on how much money has already been put into the system. Well, since that little spike up there, that looks like the limit buying may have abated. There was some significant absorption at 12, and it looks like there will be some more at 11.5. But it's kind of starting to look like that let's wait a little bit. Possibility that if there was a big buy meta order here that pushed it up, that it might be over and that we're getting the post meta order impact. Yeah, Brannigan saying here, sometimes Brannigan says things that are like kind of like no duh. Sometimes he says things that are like, I don't think that you actually know that. Higher inflation goes, the lower bond yields go. Why? The Fed will be forced into hiking and the economy can't handle higher prices. Businesses will collapse. I think higher inflation now points to a higher likelihood of global recession. That seems that I think might be the bet that some people are making with trying to buy it here. But I wouldn't, obviously yields did not decline. Recommendations for resources that help in gaining the understanding to develop that model for my Bitcoin. I don't know. I can't say. I have a Patreon where I post the charts that my model generates every day, so you can look at that. If you go there, you can see the posts from a week ago, so that you can kind of look at how much historical efficacy it has, and how you might want to trade it. But I post it when there's significant developments. By the way, has Bitcoin changed today? I don't know. I can't say. I have a Patreon where I post the charts that my model generates every day, so you can look at that. If you go there, you can see the posts from a week ago, so that you can kind of look at how much historical efficacy it has, and how you might want to trade it. But I post it when there's significant developments. By the way, has Bitcoin changed today? No, it has not risen today. It's still down at 3,200. I should post a note today because it's a little weird that they haven't reacted to the CPI. NASDAQ trader says that was a horrible, horrible open. It really was, right? Now, if you want to know more about treasury modeling, there are so many books. And if you search for anything about like treasury modeling or the yield curve, those books will talk about that stuff. Okay, so I am not hearing anything on my news squawk, but we are getting some sweeping sell orders come into the market here. Oh, thanks, Win. Yeah, I need to update the Patreon. I haven't been, I used to do it every day. I haven't been doing it every day because there's not something to write every day. Especially when Bitcoin gets quiet. But the Bitcoin thing is interesting because Tether hasn't printed in a long, long time. And you got to ask yourself, like, why would it just all of a sudden stop? Given the situation and everything, why did it just stop? It just completely disappeared. Right? But as such, Bitcoin doesn't really go anywhere. It's like if there's not Tether printing, the market doesn't move. Doesn't that concern people? I don't know. Well, I never turned my algo on. Should I turn it on? Oh, it looks like it wouldn't have taken any trades through all of that anyways. Maybe right there? Nope, it didn't. Wasn't quite enough. He said, does internet speed matter in trading, like 100 megabytes per second versus 50 or 500? Well, so what you're talking about is like if you think of the internet as a water pipe, when you talk about the megabits per second, that's like how fat the pipe is. So how fat the pipe is isn't a huge deal. Pretty much any internet connection that you're going to be getting these days that's not dial-up is going to be fat enough. What is going to matter is how fast the water is going through the pipe. How long does it take for the water to get from here to there and back, right? And there, yep, your ping. There, what you're using for your internet and your network can matter. But gaining an advantage in that area is very, very difficult, right? So the first thing is I would not recommend using Wi-Fi. Use a Cat6 network cable to connect yourself to your internet, right? But then from there, it's like, okay, I can use a DSL, a cable, or fiber optic. Okay, well, fiber optic is going to be faster, but like how much faster? Like a few millis, for here where I live in Utah, the biggest barrier is how far away I am from Chicago, right? So to really gain an advantage there, you're really talking about doing co-located servers or something, right? So See, the E-mini, we haven't seen significant selling in the E-mini. It seems to me like that they're saying that the CPI number doesn't matter. that the Federal Reserve can't raise rates. I'm not so sure that in the long run it works out that way. What are we seeing in the dollar here, by the way? Well, when the CPI happened, the dollar went up big time, and that is retracing and is retraced by about half. The E-mini and the treasuries retraced a lot more than the dollar did, though. Patrick Rooney is asking about this. What does the bond market see that the rest of us fail to acknowledge? Was he talking about? Bonds don't care on the CPI? Well, I don't know about that. I assume your ZN trade is sim. Yeah, for sure. For sure it's a sim trade. So right now I'm keeping all of my risk. Well, I am trading a combine, but I'm not showing you guys that because it's automated and it's just going to be a big surprise when we put the video out. But I'm saving all of my risk for when the yield futures go live in August. So not trading a sim as you would a live account. Well, I wouldn't say that. I'm trading it as though I had a really larger account than I would have for live, right? I wouldn't be risking 250 to 500 bucks on a trade. But that's what I think I'm going to do here. I was thinking about taking a second contract, but now that it's with the way that it's going, I'm not going to add to it. So kind of have to start thinking about, I think that if we got to the high of the day at 18, that might be where I would have to, well, let's just say they're right there. Because I got 250 on the downside, right? So I don't know. One of the things that gets kind of difficult with a play like this is like, okay, so when do you take it off? Because I certainly could have taken it off at 03. It did cross my mind, but I said, no, I'm thinking that this is the kind of move that could go all day, right? Well, we really have to be questioning that narrative right now. So should I just take it off and say I was wrong and be done? It must be a coincidence. So every time I log in, you're usually on the wrong side of the range. Well, it would probably, well, no, I don't know. So the thing is that in treasuries, I haven't really been taking trades like this. I've only taken like 3 trades that was more than a tick in the treasury over the past like 3 months or something like that. It's been a while, right? Since I've tried to like swing something. So I am starting to sit here and look at this though and think like I think I understand the trade that they're making. I think I understand the trade that they're making. And I might just be wrong, or they might beat me. They might win. Maybe these guys that are buying it are going to be more, I don't know. Like one really has to wonder When you're 100,000 contracts cumulative delta short and it breaks the high of day, what happens? You know what I mean? Like, that starts to get a little odd to game out. Yeah, I don't know. Sometimes I just make bad trades. Another thing is that like, in the summer, I don't have very high expectations for my performance in the summer. Like I tend to just trade at sim in the summer anyways, because it's always terrible. Frankly, even to some extent in the fall. I've had periods of profitability in the fall, but it's been hard. What is good ping? I think you want to be under 50 milliseconds at the very least. But good would probably be like 20, 30. So the thing, just like thinking about the future of these CPI numbers, you have to test it back and forth to see me in Chicago. Sure. I was still thinking about what RFO was saying, right? Was like, so part of the thing is that I'm moving towards interest rates. So like that's why I've been doing all these valuation models and things like that. The kind of trades that I think I want to put on that instrument are probably going to be very different. I mean, I'll probably still be trading news, but I'm also going to be looking to take advantage of like inefficiencies in the yield curve and forwards that have been empirically proven to exist to see if I can actually get them, right? So that's a big thing, right? So that's why like when I look at what I'm doing right now, and it's like, well, I've had some terrible trades lately. I have. I'm not so concerned about it because it's like, well, the summer you tend to suck, and things are going to be different when we start. It's going to be a different strategy, a strategy that unfortunately I can't really test right now. But anyways, I'm thinking about this CPI and this whole thing of like the market saying that maybe this CPI doesn't matter. Well, but what happens if in August the number is still high? So at what point does the market question the transitory narrative? Or at what point is the transitory narrative proven wrong? And I remember saying earlier in the year that, you know, we're probably going to have some high CPI here for a little bit. And I think I remember talking about all the way up until August. I saw something the other day where they were saying, I think it was the Chinese were saying that they were expecting inflationary pressures to continue being strong into the third quarter, but that it should abate in the fourth quarter. So I suppose it could be possible that we continue to get really high CPI prints until like November, December. But at the same time, I'm sitting here like, you know, if it's September, October, and we're still getting readings like this, it's going to really freak the market out, right? And then it comes back into this bizarro world where it's like the Federal Reserve can't raise rates, but it has to. I don't know. How far does that have to go before the Federal Reserve's hand is forced and they're forced to raise rates? I don't know. On the other hand, I don't necessarily have to make that big of a call, right? I think that this CPI number overall increases the probability or the time frame for a potential rate increase. Period. So it should make sense that the yields increase here today. If we were to get a lower yield today, I think that would suggest some problems. That would have to be more than just like, oh, we think that they're going to still be, say it's transitory and things like that. I think that that would really turn more into like market is predicting some sort of a market crash or policy failure. Yeah. Ralph says 14. Well, that's pretty good. I think when I haven't tested in a long time, but I think that my ping to Rhythmic was like 40. Okay, well, it's the top of the hour. Market's been open for about 30 minutes. We'll see if selling ever comes in here. Timo says, why are stocks up? I wouldn't really call them up. So at the moment, the price action that we are seeing can probably be explained by both liquidity inefficiencies and a possible contrarian trade. Okay. So I think it's too early for us to say stocks and bonds, everything went well off of the CPI, even though it was really bad. Okay. But I do see order flow in the 10-year. The overall cumulative delta, that is the market sells, we started at negative 160K and now we're negative 260K. So there has been a net 100,000 contracts sold, which is one of the largest changes in cumulative delta I've ever seen. Okay. So there has been a lot of market selling. And despite all of that, the treasuries have come back up almost to break even. So that suggests to me that there is a contrarian trade going on here. And I believe that the contrarian trade is probably that the market is saying that despite the high print, that the inflation is still transitory and that the Federal Reserve is not going to budge from its position, and ergo it doesn't matter. The rates will remain low and the stocks will continue to push up. That's what I think they're saying. Or that's the play that they're making. I wouldn't make it a foregone conclusion that that side is going to win or that that side is going to lose. I suppose I am kind of making a bet that that side is going to lose, aren't I? I don't know. I really regret not, you know what? So here's the other issue is like when I don't take it seriously. It's like I took that swing. I want to prove to myself that I can take the swing, but then I start talking and I don't really pay attention to it as much. Should I have taken it off when it got back to 07? Probably. There's a more accurate meter for news strength and volatility than Forex Factory. I don't really rely on that to determine how volatile or strong a piece of news will be. I think if you're going to trade news, that you should be able to determine that on your own. JP Morgan's Diamond, we talk about loans being down. The consumer, the pump is primed. The consumer, their house value is up. Their stocks rises up. Their incomes are up. Their savings are up. Their confidence are up. But that doesn't mean that they want to take out loans. Well, oops. Okay. It looks like CPI was more juicy than the open. Well, that's for sure. But I mean, we got a decent excursion from the open long though. And look, they were never able to push below the open. Right? I don't know. I feel so I'm just gonna exit this just because I feel like I made so much of a mistake in managing it that it's like not even worth trying to work something out anymore. I think I should go back here. I can try and pull out one tick, and I will just keep an eye on it. But I think maybe I'm end up being right in the end, and we do push back down. But I think that either way, I made so much of a mess of managing that it doesn't matter. It was slow though. Well, yeah. I mean, there's not much of a change in cumulative delta, right? 2,000 contracts long in the E-mini. It's kind of weird. But again, like you have to wonder, okay, if the treasuries get back to the high of the day, how does that work? Because that's kind of what it's looking like it's going to do right now. I think that if you're on the so I think part of my issue here is that, like, if you're on the contrarian trade, how much upside really is there in it? You know, like, are they going to break the high and then go higher? I really highly doubt that. I mean, there's certainly some order flow imbalance that could do some really crazy stuff, but I don't think so. I think that it kind of is more of a, hey, you know, this should increase rates, but it's only a little bit. Maybe they just find balance in this area. I don't know. I feel bad though. I feel dumb. The holding it, like, just completely ignoring it and then looking at it like, oh, it's back to my break-even point. Well, I should just double. I don't think that at that point, like, I mismanaged it, but then at the point at which I had realized I had mismanaged it, I wasn't thinking straight. So I'm just gonna sit on the side here and watch for a bit. See if it actually presents a real opportunity for me, a real inefficiency of some sort, since the news didn't seem to generate alpha for me. You just shorted the Euro USD? I don't know. That's a tough call. It does kind of look like as soon as I'm out of my trade that it's going to go against me. Or that it's going to go my way finally. That's 3 and 3. That would have allowed me to scratch it there, wouldn't it? So it was 11. I'd still be down. All that tells me is that they're still pretty easy for them to move right now. Trail it manually. So I've done research about that though, and it doesn't help. So this is really a unique situation because but you say that that's not manually. I don't know, man. So the inefficiency that I was trying to take advantage of there, I think this just seems to be a really unique situation where it's not that useful of a niche. right? Because what I would normally like to see is like a strong move down, a pullback based off of the order book trying to rebalance, and then continuation. Instead, we got more like a V-shaped recovery. But then when you look at the cumulative delta, it's all straight down. I've never seen that before. So I don't know how you sort that out, but I think that I'm just going to say that this was a situation where the trader was wrong. Now, the issue is that I mismanaged it at the same time, right? That was one where the trade was wrong, but I probably could have made money if I had managed it correctly, and I didn't. And I wasn't paying attention to the order flow enough to know that it was gonna flip up here if there was something down in here that I missed. That's kind of why I feel like I mismanaged it, because I wasn't really watching it very well. I was looking over here and I was talking to you guys. I've gotten too much into the habit of doing that because of it's summer. Nah, this is because it's summer. Right? Why is NASDAQ going up? I don't know. It might not be. Let's just wait and see. You're asking a question that I feel like we can really only definitively answer until after the fact. Let's call it energy drink, okay? So you're asking a question that you can't really definitively answer until after the fact. If we close the day higher on the NASDAQ, then it's like, okay, what's going on? Yeah. Okay. RJ Will says a rate increase would cause a sell-off, but then what reality sets in rates still too low, markets still attractive? How do we put this? I think that the reality of how that plays out is actually like way more complicated, right? So I think that what really happens is in August, the Federal Reserve signals that they're going to start unwinding some of their QE. There was would have liked to have been short there, but that's okay. And then they start talking about the schedule for when the rate increases, and that it still ends up being like late 2022 or something like that. And then who knows what happens from there. You know what I mean? It's like we want to think that the CPI being that high is like this huge warning sign. I feel like it could affect markets. I don't know how to model that, you know, but in terms of what impact it has on the treasuries, a downside move is definitely justified, but I think we're now realizing that my initial assessment that was like, well, this could just sell all day was probably a little bit too big of a call to make. Clearly, there's more nuance to what will happen, and there's more nuance to what the overall market's opinion is on this news than that, knee-jerk reaction was really warranted. Yeah. So I think that when they raise rates, it'll be just like last cycle that, it kind of changes growth projections and stuff, but in the end, it's not really wouldn't have been a reason to sell your stocks. But it was a sell though. Well, I think that the news justifies selling all of the things. Yeah, it's just how much, right? That's the problem. Is how much, and the way that we should just note that the way that the order flow is behaving right now is not in line with how it would normally behave. Right? Normally we would get like a pull for it to come all the way back. Let me re-describe here. Normally you'd see something like this, and then it comes down, and you'd see the cumulative delta would be doing the same thing. Okay. Now, what if we get a move like this? What if let me back up. What if the cumulative delta does this? Right? And these are equal to each other. Okay. Well, what you should actually expect to see happen based on the inverse square law is something more like this. Okay. That's what you should expect to see happen. Okay. But what we got instead was like this and almost a bounce, almost a complete bounce. Okay. So the order flow in the 10-year treasury is doing like something crazy unusual. So I can't say for sure what the impact of that is going to be, other than that somebody has to be buying a lot of stuff on the limit. But where it goes from there, I'm not sure. So that's what happened in the treasuries. You look over at the stock market. I don't know. Do they care? I don't know. But that's why I'm saying, because kind of the key thing turns into, okay, but like, what is the aggregate impact? How much should it really actually, if I had a model, what would my model say about how much it's supposed to change? Hard to say. Normally, you get some signs. But today, the order flow is kind of telling us some contradictory things, so we can't determine that. That makes it a hard trade. If it goes up, then those deltas must have been absorbed. Well, yes, but that doesn't tell you what's going to happen next, right? This one, if I get a meta order down and then an equal meta order the other way, I can predict that the price action is actually going to move higher. With this one, because they're doing it with limit orders and everything, I can't really predict where it's going to go. Can't really predict what level it's going to get to. Is it done? Could just be done at 12.5 and they just settle there and it stays here and nothing happens, right? How do we know that? Do you have any kind of statistical thing that tells you that it's going to do something from here, or that is significant? Because I don't. The only thing that I can do at that point is try and read the news. And if somebody's taking a contrarian trade off of the news, then it's kind of like all bets are off, right? Or at least I think that that's what I should be doing. Now, I suppose one other thing that I should note is that when you're saying like those deltas must have been absorbed, well, that does happen. But another thing is that there has been kind of some offers pulling. So, but what are you trying to say, Nasdaq? You're not saying anything that makes any sense at all. If you want to go and buy it, then go buy it. It doesn't sound like you have a very good reason to be frank with you. Does the market have to go down, though, no matter how bad CPI home sells? Well, sure. Based on the order flow, it can do whatever it wants to do, right? So the trade is over? It may be that the trade is just over. I don't know. The thing that I'm trying to stress is that the movement that you're seeing is not based on the math that you normally get. It's not what normally happens. So we're looking at a kind of a special situation, and I suppose the theory is that the cause for the special situation is a contrarian trade. And kind of where I'm getting to is, okay, but have you ever seen a contrarian trade of 100,000 contracts in the treasuries? Because, like, how is that possible? Yeah, it's a lot. Well, it would have worked in the 5-year, but not in the 10-year. That's funny, because the 10-year was the one that was lagging. So the trade is over. I don't see how you can say that it's over. How do you know? How do you know that? It might be over for you because it hit your target or your stop. Yeah, that one sucked. You don't know. Yeah, there you go. I don't either. We can like that's the thing, is we can only go through like, what do we know? Okay, what do we know? It is extremely unusual to have a cumulative delta change of 100,000 contracts, and it is extremely unusual to see a cumulative delta change of 100,000 contracts and have price be almost practically unchanged. Not practically, they were still down a good bit, okay, but almost coming back to unchanged. Highly unusual. That's something that we know is different, okay? Having a CPI that big, that's something unusual, and we know what those actual numbers are, and we could potentially try and price out what the impact on the economy is. We also know that the Federal Reserve thinks that it's transitory, and that this particular report probably isn't going to change their opinion on that. That's what we know. Now, what are we trying to do? We're trying to use that information to predict short-term changes in order flow. Okay. So I suppose I made a correct call at one point when I took the sell, but I didn't get the other half of the trade correct. I don't know what I did wrong down here, but I did something wrong down here. I need to go back and look. Right. From here on out, we don't know what will happen. Yeah. But we're all certainly all wondering, because you've really got to wonder with the way the E-mini is trading right now. What's going on? I suspect, though, that we're going to get a lot of really... You would say, I don't think you did anything wrong. Well, I mean, I did. So let's put it this way. If that was a live order and those were the decisions that I made, it wouldn't have been very good for me, right? Wouldn't have been a very good day. Would have been a really big missed opportunity. I'd be kicking myself. So the reason why I feel like I made a mistake is because I don't feel like I actually did behave the way that I would have if it was a live order. I think that if it was a live order, I would have been much more vigilant on when it came back and taking it off when it retraced like 50% or something like that. Yeah. The entry signal was okay, though. You're right about that. And we actually had like a really good order flow kind of signal set up there. So that it actually had turned out as well as it did was really great. And we didn't really get much adverse excursion on it either. It's just that, like, when I took that trade, I wasn't taking it on that short-term signal, right? I was trying to make a larger term play that the treasuries would close the day on its lows. And that, I think, was wrong. Right? So I wanted to come in and like hold it all day. Well, we're probably not worth holding all day. From what I'm looking at right now, if I hold it all day, I don't think that I'm going to see the low of the day again. I could make that prediction. Then we might sell again, but I don't think that we will see new lows of the day in treasuries. But when it went down, the amount of selling you thought would bring it even further didn't. Well, so here's the thing is, like, if we come back and you look at the chart. Okay. So here's where I took it, somewhere in here, I think. I took it at 11. Oh, you know what? I did have some excursion. So I took it at 11. There was this excursion against me. I held on to it, and it did this. And, I mean, look at this. That was a good decline. I mean, it moved it, right? Then there's all of this. Like, ever since then, it's been flattened down. The question that I'm asking is, what happened in here that I missed? If I started to watch the ticks as they happen, I mean, I could look at the volume profile, right? But that only tells me so much, right? The profile was that there was a node right here. So probably what should have happened is I would have seen a situation in the latent liquidity that would have made me want to take it off. Some got absorbed. I would think that it wouldn't necessarily be absorption right there. It would probably be like a big trade and a lack of latent liquidity, and then it would build out that profile there. So I probably missed something right there. That's probably where I was supposed to get out. But like I said, I ignored it. I wasn't paying attention, and even if I was paying attention, I might have ignored it because I was trying to turn this into a swing trade. So, swing trade experiment failed. Swing trade experiment failed. Trading the news, short-term news based on order flow, probably really good if Seth was actually on the ball. So, yeah. It shouldn't shake your faith in, can you make money off of trading the news? Because I think that one would be a pretty good example of showing you where you can. Yeah. That's where a trail is useful. Yeah, well, so like the thing with the trail is like, okay, how do you trail it? First of all, how do you trail it? But you just got to realize that a trail inherently reduces your maximum favorable excursion. And yeah. Like there's any way that you put it, it's probably not going to go as far. Is that based on order flow? I don't know. Like I can look at order flow and I can say, well, like, okay, let's put it this way. Okay. So we saw a flat delta and it come back. Okay. So at the point that we were at 080, was that telling us to get out? Because that's never something that I've looked at as a reason to get out. In fact, seeing it flat like that would kind of just suggest to me that even more selling is going to come in and is going to move it down. So, like I said, I don't think that my current understanding of markets, this is too weird of a situation. It's too weird of a situation. This thing right here, what was I going to see that was going to show me that was going to happen? Probably not. So then what do you trail it at? Well, I don't know if I could trail it, but I could certainly have put it at break even, right? And I would have stopped out right there. Right? But you just got to remember that if you're trailing your stop, it's always, there's, what if it had done this, right? We're just saying this is a possibility. But another possibility is it came down and it did this, okay? So, and this one up here, it hits your stop, right? In this situation, it hits your stop. In both situations, it would hit your stop. But in this situation, you could have made more, right? The trailing stop always reduces your max profit. That's just what happens. Does it reduce? Do the numbers work out once you do that? That's the question. How many times does it save adverse excursion versus prevents favorable excursion? You would have gotten in and out 3 times. Yeah, I mean, normally I think I probably would have done multiple trades too. That's why it's kind of disappointing, I guess, is like if I come in and I say, well, let's do an experiment and try and swing it for a longer trade, and then that doesn't work. And then you turn around and you say to yourself, well, you could have scalped it a couple of times there and won. Okay, but you didn't, and would you have done it? No way to know. No way for me to know. But I'm probably stressing about it too much because here's the real question is like, if I'm not going to take on any risk until August, what should I really be doing right now that would be the most beneficial to me? Because I'm not really sure. I kind of just come in and do what I feel like, and sometimes here during the summer, I think that's led to bad consequences, but I'm not sure what it is that I should be doing. So, I thought that trying to make a decision on the longer term play would have been a good idea. Maybe not. Maybe it was a good decision and I just happened to get one wrong. Could have been worse, right? Got more favorable excursion than adverse excursion, so I can't call it a horrible trade. Oh, HF asked, when is Powell speaking? Good question. Didn't check that. We should note there is a 30-year bond auction at 11 today. Well, I really have to wonder, do you really think that there's going to be a ton of demand at the 30-year bond auction? I don't know. I don't know, man. That one seems a little... Okay. But then... no, all I have on my calendar is Bostic speaking. At 10. Well, noon Eastern time, but... I don't know if he actually is. New York Fed purchases $5 billion in Treasury coupons. What? Okay. Oh, I guess Goldman Sachs is doing its earnings call right now. I don't know. I feel like that being able to play a longer term play would be really useful, but I also think that keeping focused on flow is useful too. But I also feel like that keeping you guys entertained is good too. But I don't know if you were really entertained by what we talked about. Did we? The fact that it comes back on you as negative, well, that's true. I'm just saying we shouldn't say that everything about it was bad. And so if the point of it is to learn, then what should we be doing differently that will help us learn better next time, right? Like there's the what should we have done with the trade, but I think that more importantly is how should I be trading that I'm going to learn the most from it, right? Well, maybe trying to take the long play, I do learn a lot from it. Because in that situation, I considered too much the core knee-jerk reaction and not enough the possible contrarian trade that can come about. I guess I can't really think of a time. Well, yes, I can. I can think of times where there was a contrarian trade and I was really I wouldn't say confused, but disappointed by how it worked out. It's not the first time. So from that perspective, what I need to learn is to think about that a little bit more and try and see how I can detect that condition is happening. The issue is that when I look at the flow and everything, so if I'm thinking of it from that perspective, I don't really see anything that would have been like a canary in the coal mine per se to really tell me that was going to flip. I suppose one thing that I could have seen that was bullish was that kind of reversal flip around the open, around the time that Ace comes in when it turned long. That's something that I could have looked at. if the entry is arbitrary. Well, it wasn't an arbitrary entry. Sometimes I do make trades in like more of a swing that is like just like, well, this is what price it is at now, and I think this is what's going to happen. So this is as good of a price as any, because I don't have any other kind of edge to further. What is the word I'm looking for? Tweak my entry. So sometimes it is just arbitrary. But that one was not. There was actually a pretty clear and effective signal there that worked out. Yeah. Perfect trade doesn't have a perfect trade, I guess. Maybe. I kind of feel like I used to think about that. So I used to feel like, okay, the trades that you really want are the ones that like never go against you and stuff. But I've kind of turned to like, how effective can you really be at catching those and only those? I don't know, man. I haven't been able to do that, right? So if we admit that we can't actually predict those, then really if it goes to your target before your stop, then what it does in between, does it really matter? I don't know. I would still rather it not go any be against me, but I think that's just like my own selfish desire for safety. I tell you what, the treasuries sure have slowed down, haven't they? In fact, the last, I'm going to say, really since the top of the hour, so really the last 40 minutes have been kind of, yeah, ideal. There you go. Ideal would be a better word. Would be ideal. An ideal trade wouldn't have any drawdown, I suppose. But do you get what I'm saying, though? Like, I'm questioning if that ideal really helps us. Or if that's just something that we would prefer to see because of our own desire to not have adverse excursion. Because it makes us uncomfortable. Does it actually help the efficacy of our strategy? Yeah, you get in first and you get executed last. Okay. I don't know if that makes the strategy better. Or rather, let's try and rephrase this. Would minimizing adverse ticks make the strategy more profitable? You have two strategies. They're generally the same in terms of like what you take as stops and targets and everything, but the difference is that this strategy has less adverse ticks against you than this strategy. And the question would be, does adverse ticks against you have an effect on the average win rate of your strategy per se? If we took like random strategies and we just, let's do it like that. Let's say that we took 1,000 strategies and then we graphed against some adverse ticks versus win rate. And let's just say, for the sake of argument, that every strategy in our 1,000 strategies is equal risk reward. Then is there actually a correlation between adverse ticks and percentage winners? Okay. It seems like it probably would. Stickball says, I would think adverse ticks would show more profitable winning trades. How so? Because I look at it like, okay, the less adverse ticks you get, the less chance you have of it that it's actually going against you, then the percentage should change, right? Less adverse ticks should, in aggregate, result in better probability. Should, in aggregate, result in better probability. But then I'm thinking the other way. Think the other way. Let's say that we did it again, but all of our trades were 2-to-1. Our winners made twice as much as our losers. Wouldn't we have a better chance of getting, twice as much our way if there's a little bit of contrary order flow going the other way? More people to stop out to move it up to where we want it to go? Is a theory, but it's all we're all talking about things that we would have to test to prove, right? So I guess I shouldn't be trying to make it seem like I'm taking the position that it's true or false, just that I think it's worth questioning. Price moves sideways up or sideways down, that's a negative for drawdown, even if you predict the moves. Let's say it this way. The less time that you are in a trade, the better. So if you have two strategies and they both made $1,000, but in this one trade, you were only in the market for a total of 1 minute, or this strategy, and in this other strategy, you're in the market for a total of 12 hours to make that much, then you're getting paid better for your time risk. So it is better to not be in a trade. So something that goes straight to your target immediately is better because you're in the market for less time. If you have a meta order going against you demanding liquidity and the temporary adverse excursion is for paying for liquidity in that small period of time, if you as a liquidity provider then takes liquidity during that time period, then you should pay hugely for it. Yeah. I'm wondering, it does seem like that there was some offers pulling up here. I'm kind of wondering what I could have looked at that would have told me that these were going to pull. Because I do tend to look. So, how do I describe this? Okay, so cumulative delta is a strong indication of informed trading, especially when there are, like 100K cumulative delta short. That's a really strong indication that a lot of informed traders came in and made a trade based off of that piece of information that we made, right? Now, for us to continue getting a solid 50,000 contracts short, but actually move up, that's unusual. So does that suggest informed trading as well? Because I think that's what the argument that you've really been making from the beginning, Nasdaq, right? Is that does suggest informed trading. So it's informed trading happened and it happened in a way in which cumulative delta would not have clued you into it. Yeah. So what's the other indicator that you could look at that would detect or signify the informed trading, right? Let's say if cumulative delta and price go opposite directions, how much of that can go through before you have to start wondering if there's informed trading, right? But that comes back to the trailing thing, is like if we're flat, if the delta is flat, oh man, I don't know, man. That just goes back to the same question though, is like, how much did we pull back from here to here? 02 half to 07. So from here to here, 1, 2, 3, 4, 5, 6, 7, 8, 9. So we had 9 ticks up. 9 ticks up, delta flat. Can you say that's informed trading? Is that alone, that it ticked up 9 ticks and the delta was flat, is that alone an indication of informed trading? Because in my mind, after news like this, it could just move 8 or 9 ticks randomly, you know? In my opinion, delta is much more important when markets are big in ZN. That's probably true, but I think that there's a lot more that factors into it than that. NASDAQ. So, like, do you think that order flow is less useful in ZB, for instance? Because I don't think that it is. I just think that in ZB, you might need to factor in other things like the spread and stuff a little bit more, but that the order flow is still really useful in ZN. But the comparison that you're probably making in your mind is, okay, is the cumulative delta in ES more or less useful than it is in ZN? And on that, I would agree. Cumulative delta is way more useful in CN than it is in ES, because seeing a move completely against the flow in ES is not uncommon at all, right? But I think that that is not because the ES is less liquid. I think that that's because it's an index, and the flow that we see, the big order flow that we see in ES, is more hedging than anything, right? And so you shouldn't be surprised to see something completely against the move, because it's just people hedging. What about commodities? Well, yeah. Well, that's exactly why I think that oil is kind of attractive, right? Because in treasuries, so they've done some studies on the market structure of treasuries, and the general conclusion that I got from that study was that price discovery happened in the futures. Okay. I don't think that price discovery happens in the futures in ES. I think it's more complicated than that in ES. Okay. In oil, price discovery happens in the futures. Why does price discovery happen in the futures in oil? Because that's like literally the only place that they trade is light and Brent, right? So there, you know that the price discovery is going to be there, and that you should be able to read the order flow and be able to get some insights from it, right? If we saw a move like this in oil, I would be like really weirded out, right? Okay, so let's think about this for a second. In the context of a hedge. So why might you be buying the treasury and it might just be a hedge? Maybe perhaps you are really concerned about hyperinflation, and you think that yields will decline when the economy crashes, which is to say you'll get like hyperinflation and then a complete collapse in prices. You get hyperinflation followed by a period of rapid deflation. Even if it's a hedge, it has to be shown in delta. Well, sure, but I guess one of the things is that a hedge is a little bit more likely to happen on limit orders. That's a theory that's not proven, but it's certainly a widespread belief in the market. I've never seen any data to prove that that's the case. There's been some interesting data about how informed trading definitely does happen with limit orders in treasuries, and it happens more often than in other markets. But do hedges more likely to happen with limit orders? I've never seen any data on that, but it's certainly an opinion in the market that's around and is widespread, right? Which might mean that it's nonsense, but if we just take for a second, sometimes going through to different extremes can teach us something about what's actually going on. If you were going to do a limit order and you were just hedging on it all the way back here, what would be some things that would signal to us that that's what was happening? Well, I suppose one thing... Oh, okay. So one thing is that if it was a hedge, there would be a point at which I wouldn't be willing to pay up for it anymore. So that we've gotten to 12, 13 or so and just kind of drifted here would be supportive of that theory, yeah? Let's just call them limits, Seth, for the sake of parsimony. Okay. And then, well, I don't know if I want to use the limits, but I'll just say limit orders. Point number 2, though, would be spreads. Yeah? Spreads would probably give away the thing. The thing. Okay, so what did the spreads do? 30 and 10s flattened. 5 and 10s flattened. 2s and 10s steepened initially and then evened back out and are unchanged. Six says, hey, what did you really mean by the price discovery being concentrated on CME crude oil futures making an attractive market trade? Can you name to me anywhere else that people trade oil? There's not another market that I know of. You mean he did make a new high? I didn't notice there, but that little spike up above was enough. Oh man, it's already 9 o'clock. Well, okay. Didn't take a trade today. Maybe if I had opened it up earlier, it might have taken one, but that is the algorithm. But when I look back through all of this, I don't see anything that getting to that threshold. It comes close, but it never actually crossed the threshold. So the flow in the treasure... Oh, actually, there was a short somewhere here. Yeah, but that one got filtered out. It didn't take it. Okay. So we're just going to say no trades today on the robot. Okay, anyways. 6 says, do you mean there may be more edge? I mean that the order flow in that instrument will be more predictive than it will be in other markets. Because there's no, like, one of the things that will reduce the effectiveness of order flow is market segmentation, right? For instance, if I was to go and I was only watching the order flow of a stock on the ARCA exchange when the majority of the volume is traded on the NASDAQ, can I really glean too much information from that? I suppose it depends on how effectively the order flow in the ARCA reflects the order flow in the NASDAQ. And I would need to be able to see both to be able to verify that, right? But if that's like literally the only place that it's traded, then I know that there's not any kind of hedging or, some dark pool stuff going on. Like dark pools is a big point behind where it's like, yeah, there's certain things that you're not going to be able to see that will screw up your order flow read, right? That's where, it really comes down to when we're talking about order flow. I think really what you want to look for is what flow is actually predictive. Like what says that there's informed trading out there. That's what my algorithm looks for. Is it looks for things that it has found are signs of informed trading, and then it follows the flow. Are there dark? No, I don't think that there are. Not in the way that there are stocks, at least. Anyways, I got to get going. So I will see you guys tomorrow. Hopefully a better day for us. I shouldn't say that it was terrible. I think we had a good discussion and we learned a lot, yeah? So why bring them up? I don't know what you're saying anymore. I got to go. Stay profitable.